Let's go.
All right. All right. Good morning, everyone. Thanks for coming. So as Anders mentioned, my name is Joe Consorti. I'm the head of growth at Horizon and Theya. Horizon is a home equity into Bitcoin business, and Theya is a self-custody business for businesses.
Hey everyone, Jackson Mikalic here. I'm at Onramp. I lead our private client and institutional sales. We focus on multi-institution custody for Bitcoin and financial services built around that custody solution.
Awesome. Hey everyone, I'm Joe Burnett. I'm Director of Bitcoin Strategy at Semler Scientific, and happy to be here.
All right, phenomenal. So I'll kick things off. Today we're talking about custody models. So obviously Bitcoin custody is extremely important, and it's more important for Bitcoin Treasury companies. Obviously the MO of public companies who are buying Bitcoin is to buy a lot of it. And so with that comes a great deal of decision-making when it comes to how you're going to custody your Bitcoin. Totally disparate custody models out there. Basically, everybody is choosing to go with an institutional custodian of some kind. Many of them are choosing multi-sig. Today, we're going to talk about those different models and the trade-offs between them. The one I want to really start off with is multi-institutional custody, essentially what Onramp specializes in, what Theya also offers to businesses of all kinds. Really, the benefit of multi-institutional custody is you're distributing ownership of your keys. Meaning no single party has access to your funds. And that's extremely important because over time, we've all seen what can happen when you leave the funds up to one party. You open yourself up to a whole host of risks, obviously counterparty risk, but also rehypothecation risks. Folks that will take collateral and then post it as collateral elsewhere and do that several times over. And then when folks come looking for their funds, the Bitcoin is nowhere to be found. This is an even more acute risk for institutions, as I mentioned, who are holding a lot of Bitcoin. Joe Semler Scientific now has over 5,000 BTC. That's a lot of capital right there. And so it brings about these questions that we're going to discuss today about what is the best way to do these things. And when you're talking about that amount of Bitcoin, eliminating single points of failure is extremely important. And that's what multi-institutional custody, but also just multi-sig generally allows you to do. Is by instead of making it so that you can access your funds with just one key, having 3 keys or even 5 keys in your setup can completely eliminate those single points of failure and make it so that if one of those keys gets compromised, your funds don't get compromised. And ultimately, that's a story you don't want to have to explain to investors about how you lost all of the Bitcoin that you purchased on their behalf, right? Your MO is to increase Bitcoin per share. What you don't want is to lose that Bitcoin or have a security model that has holes in it, that has the potential for you to lose your Bitcoin. So ultimately, that's really what multi-sig is all about. I want to talk about briefly proof of reserves as well. Proof of reserves, extremely important when it comes to investor relations. One of the main things that gets talked about today, one of the main talking points against Bitcoin treasury companies is this idea of paper Bitcoin. A lot of detractors will look at Bitcoin treasury companies and they'll say, well, there's no way to prove this entity holds their BTC. Many institutions have said for various security reasons, they don't want to publish addresses or make it readily known to the public. A way to work around this is through multi-institution custody or multi-sig. What Theya offers, what Onramp offers, what Unchained offers, and what you can do in-house as well. And so there are many things we can discuss today, whether it's assembling a team to do this or hiring one of these companies to do this for you. But really, it's a very important topic. I talked about paper Bitcoin. Investor relations are very important. Building trust is what matters more than anything else, right? Obviously, when it comes to building a Bitcoin treasury company, you want great operators. You want a sound methodology to increase Bitcoin per share. But importantly, you also want to build investor trust and maintain that investor trust. And one of the easiest ways to do that is by being transparent in your Bitcoin holdings and having proof of reserves. And by holding your funds in multi-sig, you can offer that transparency to your investors about where the Bitcoin is, how much of it is held, without opening yourself up to the security risks that many have cited as the reason for why they don't have proof of reserves. So that's where I'll leave it. Wanted to keep it pretty high level before I pass it off to Jackson. So Jackson, you can take it away.
Thanks, Joe. Nicely said. So I want to see some hands. Who thinks we're still early to Bitcoin in this crowd? Okay, so the reason I ask that is because I agree with that statement, and also because if you believe that we're early to Bitcoin, what I think is underappreciated often is that that means solutions that have existed thus far have been for early adopters, and we haven't yet seen kind of the final form of financial services, infrastructure, and custody. It's always evolving. And so why are we talking about custody today? In my opinion, Bitcoin custody is the thing. It really is the most important thing that investors, whether it's a corporate balance sheet, it's an institutional investor, it's an individual investor, this is the most important thing that you need to get right. Because as we all know, with Bitcoin, there's only 21 million, and there are no bailouts with Bitcoin. And if you mismanage the asset, then you may be sitting on permanent losses, right? I think a lot of people in this room would think of Bitcoin as a generational asset and potential generational wealth in the future. And for corporate treasuries, that applies in a similar way. But you could have a generational loss if this asset is not managed properly. And so this is why custody is so critical to the conversation. And I would say that if you look at Bitcoin as a $2 trillion asset class today, the fact that there's been hundreds of billions of dollars that have been lost due to poor custody in this space is evidence that we actually have not figured out custody, again, in its final form. And so what options exist for custody? I think it's always important to talk about what options do investors have, and we can focus specifically on corporate balance sheets today. There's really two main buckets that investors can choose from. There is self-custody and there's third-party custody. And in self-custody, that implies that the end user, whether it's an individual or it's a company, is managing the keys for that asset. And so this comes in different flavors. You have single sig hardware wallets, you have multi-sig, you have collaborative custody. And I think of all these solutions as some flavor of self-custody. Ultimately, it's the responsibility of that end user, in this case, the corporation, to be managing the asset themselves. It's a great thing from a sovereignty perspective, from a control of the asset, but let's be honest, it can be incredibly daunting if you're managing millions, tens, hundreds of millions, billions of dollars of capital. There's a lot of risk there, just from turnover, from having expertise within your department or within your firm to actually manage this on an ongoing basis, insider collusion, physical threats, you name it. The flip side is that you have third-party custody. And so third-party custody, typically you're handing over control of your Bitcoin to a third-party custodian. They're managing all the keys on your behalf. Again, there are a lot of benefits to this. It's convenient. You're outsourcing the responsibility to a firm that should be experts at it. But at the same time, you're taking on a lot of counterparty risk. Since that firm controls all of the keys, that opens up the door for a hack, opens up the door for mismanagement, firms just outright losing keys. We saw this in 2022. It opens up the door for your Bitcoin to not actually be sitting in cold storage as you think it was, to Joe's point on proof of reserves. And so ultimately, my conviction is that the reason why we've seen so many losses in this space historically is because both of these solutions, self-custody and traditional third-party custody, where you hand over control of the asset to a single institution, they both have a lot of trade-offs. But I think we've done the best job as we can of an industry. And going forward, what I see is a lot of what Joe described, a multi-institution custody being the standard. Before I get there, what I see a lot of times now with companies is they already recognize the inherent risk of trusting all their Bitcoin to a single custodian. Mm-hmm. And what they do, this applies to public and private companies, is they are diversifying custodial risk. They're parking Bitcoin at various exchanges or various custodians, so they don't have all of their eggs sitting in one basket, and they don't potentially have a 100% loss they could be looking at. Maybe it's 25%, maybe it's 33%, maybe it's nothing, of course, right? And so there's already a recognition that there is a lot of custodial risk. And so ultimately what this leads to are other solutions, leveraging battle-tested technology like multi-signature, and namely multi-institution custody, in my opinion, will become the standard for Bitcoin custody, because for the reasons I just mentioned. You don't want to have all of your Bitcoin sitting internally. Also, you don't want to have a single point of failure. You don't want to wake up one day and the Bitcoin you thought you had on your balance sheet is no longer there. So with multi-institution custody, I think Joe hit a lot of the high notes, did a great job. Instead of one firm managing all the keys internally, you have 3 or more independent institutions. They all manage a minority of the key set, so none of them actually control. In this case, there's 3 independent institutions. They all manage one key. You need 2 of 3 signatures to actually effect control to send a transaction of that Bitcoin. So what you're actually solving for, and then I'll wrap up, is there is no single point of failure. If something happens to one of these institutions in multi-institution custody, you don't have a loss because you only need 2 of 3, or maybe it's 3 of 5. And so we're effectively solving for the biggest, the most important thing in my opinion, because at the end of the day, growing Bitcoin per share is important, generating alpha is important, but if you don't have a rock solid foundation of custody, then it could be all for nothing. So,
awesome. Thanks, guys. Yeah, I think this panel is particularly interesting to me because now I work at Semler Scientific as Director of Bitcoin Strategy. But before that, I worked at Unchained, which is another collaborative custody provider. But first, before I get into some of the details, I want to talk about why do I think custody even matters, right? When you think about traditional finance, whether that's equities or bonds, these assets inherently come with counterparty risk. So custody of those assets isn't really part of the conversation. Equities, if you're investing in a company, you have to trust that the management team will execute on their strategy and has actually a great strategy. And then bonds, obviously you're lending someone money, hoping that they will pay you back at some point in the future. Bitcoin is a very unique asset because it's an asset that can be held without counterparty risk. You have the optionality to hold it without counterparty risk. And on top of that, it has no dilution risk. As we all know, there's only 21 million Bitcoin. And so if you run a Bitcoin full node and you hold your Bitcoin private keys, then you have this unique asset that has really never existed before in the sense that it has no counterparty risk and no dilution risk. Now, for Bitcoin treasury companies in particular, I'm going to give two maybe bad examples on extreme ends of how not to do custody. One example would be, say you're Michael Saylor, you have 600,000 Bitcoin belonging to MSTR shareholders. Holding that Bitcoin on a single signature ledger hardware wallet in Michael's desk would be a very bad idea for a number of reasons. The opposite end of the spectrum is blindlessly trusting a third party. We've seen that the history of Bitcoin is Mt. Gox, FTX, BlockFi, Celsius, whether it's negligence, fraud, or just bad decisions. People have lost serious amounts of Bitcoin over time. And I think Bitcoin treasury companies obviously need to find something in the middle of that. They need something that is trusted and secure. They also need something that has a lot of risk and controls to make sure that there isn't a sovereign single point of failure like holding 600,000 Bitcoin on a single signature hardware wallet. So I think it's really interesting to think about this concept. I agree with what you guys said in the sense that it's still very early. We're still in the very early stages of global Bitcoin adoption. One of my core theses is Bitcoin is digital gold. Bitcoin gold parity would be about $1 million per Bitcoin or a little bit more. And, in my mind, I think you have Alexander Graham Bell's original telephone. You have the iPhone today. Obviously, the iPhone is worth significantly more than Alexander Graham Bell's original telephone. And I think Bitcoin could be just like the iPhone of gold. It could be worth multiples or magnitudes more than physical gold. And so I think one of the primary objectives for Bitcoin treasury companies is to not lose the Bitcoin. So doing the due diligence, making sure that you're going to, if you have trusted third parties in your setup, making sure that, they're regulated and understand, private key management, because it is a difficult full-time job when you're securing hundreds of millions or billions of dollars. So excited about the future of Bitcoin and excited about the long-term future of Bitcoin treasury companies.
All right, wonderful. Thank you, guys.
Check. Yeah, okay, so let's give this a shot. Tim, you got the other side of the room? Where'd Tim go? Tim disappeared. Okay, I'll get this side of the room. So we're gonna do 15 minutes Q&A. Raise your hand, stand up. Anybody Q&A on custody? Or comment? Yeah, go ahead. 45 seconds.
Question. Hi guys, good to see you both. Good to see all of you. When do you think the time locks are going to become standard for multi-sigs, and if not time locks on chain, what are other kinds of spending protocols or delays that you think will be introduced to this?
Jack.
Yeah, I could speak to that first. So MiniScript exists that allows for time locks as an example of spending conditions to be native to Bitcoin. But in my opinion, even before getting to that, these controls already exist from a legal and governance perspective. So I don't even think that they necessarily need to be on chain, at least not right now. In my opinion, when you're managing Bitcoin is money. You don't want to really be in anything that is, let's say you don't want to be like on the frontier. You want to be in stuff that is battle tested, and that's why we've built a solution around multi-signature, which has been used for over a decade now. And in my opinion, you can just have those controls, whether it's spending conditions, let's say velocity controls, how much Bitcoin can move out of the vault in a given month out of that cold storage, or maybe you have a freeze that requires authorization from a number of individuals within the organization to unfreeze that account. These things can be achieved from a legal and governance perspective.
Yeah, I'll just add on my thoughts. I'm by no means a mini script expert, but I'm optimistic about what it could do. Being able to do like decaying multi-sigs, or requiring that one key gets signed in a quorum of multiple keys. I think those are interesting, but I still think like we talked about, Bitcoin itself is so early. The solutions that we have out there on Bitcoin custody are still relatively early. So it might take some time before we see that, in broad adoption for, lots of thousands or millions of Bitcoin.
Very well said. And one thing I'll add here to kind of just tie it in with a bow is that ultimately the best way to custody any Bitcoin, whether you have one Bitcoin or less than a Bitcoin as a company or an individual, or thousands of Bitcoin if you're a mainstay Bitcoin Treasury company, is to make it so that you're preventing as much of a loss. You're preventing the entire loss completely. Jackson, you mentioned using battle-tested custody solutions. Multi-sig makes it so that if you lose one of your keys, there are built-in recovery options. You can recover the rest of your funds. Whereas if you're doing this strategy of using multiple institutions and spreading out your funds, if one of those institutions goes under, you lose that portion of funds entirely. And so it's a difference of loss prevention versus loss mitigation. And these time-tested utilities like multi-sig allow you to do that. I too am optimistic about Miniscript, but I do believe that using the tools that have been in the space for the longest amount of time, that have the longest track record, are the most important when we're talking about Bitcoin custody solutions for businesses.
Yeah, one of the most interesting comments at the Bitcoin for Corporations conference that we put on at Strategy in Orlando, one of the big four custody companies, the guy got up there and he says, like, even I don't know where the Bitcoin is. And I was like, half the room said, yeah, that's good, you shouldn't know. And half the room was like, what do you mean you don't know? It was a kind of a good comment. Anybody else? I'll get you here. 45 seconds.
I'll be quick. So in 2021, the initial hypothecation was okay, but then when it got rehypothecated, then that became a problem for who had the claims on the Bitcoin that happened with various companies that went under. So my question is, how do you tell the difference between a wallet management and actually changing the hypothecation of those coins? Because it changes wallets, but really it changed who has the claim on the coins. The person that has the coin can just say, well, we're just doing wallet management, but yet it's been rehypothecated.
Yeah, I mean, I can't speak to that in super detail. I mean, I know like FTX was like, a huge problem back in the day, BlockFi, Celsius, right? Like they were taking people's Bitcoin, lending it out and doing bad things with it. And so I think it's important that if you hold lots of Bitcoin, you need to make sure that you actually have legal claim over the Bitcoin, and ideally your custodian is not going to be rehypothecating that Bitcoin.
I can speak to this a little bit. So we've seen this with a lot of on-chain explorers, a lot of on-chain sleuths who will identify this type of stuff. Arkham, right, is a great example, who is kind of known for pointing these things out, and then kind of everyone on X makes a buzz about it. One thing I'll say is that the main thing that all of us discussed was multi-sig. And so you kind of mitigate around that entirely when you're simply buying your Bitcoin and sitting on it in a collaborative multi-sig, whether it's multi-institutional, whether it's fully in-house, whether you're using a third party, et cetera. And so ultimately, and we've seen that this is what the market prefers as well. So entities like Coinbase, for example, who have a lot of eyes on them when it comes to these on-chain sleuth platforms, any movement of funds that they will tell you is just moving in between wallets, there's no way for anybody to verify that. But by establishing a multi-sig setup and proof of reserves, anybody at any time can look on any block explorer and see that the Bitcoin is staying exactly where it is. And so ultimately, the question from an investor relations perspective is mitigating that entirely, making it so that it isn't even a question that ever comes up. And I believe collaborative multi-sig and proof of reserves that's enabled by that is the way that you do that. I think those practices are going away in my mind, because we've seen from the investing public that they don't like that whatsoever. They don't like when they see movement of funds What they like Bitcoin Treasury companies to do is to buy Bitcoin and hold it and know that it's there. And that third component is kind of what we discussed here. That's what needs to come next, and that's what I think will come next.
I'll just add to that quickly because at our company, the way we have our wallets structured is every client has their own dedicated wallet. So you have kind of proof of reserves of your holdings specifically, right? So one of the value propositions, and this doesn't need to be exclusive to our company, it could be for any multi-institution provider that does this, but you're actually able to verify your assets on platform or off platform, on a node or block explorer, et cetera, because you're actually able to look at your public addresses that are only for your Bitcoin. So it's almost like a little bit more granular version of proof of reserves, in my opinion. Mm-hmm. And then to your original question on movement of funds or versus rehypothecation, I think that ultimately comes down to communication. So public or private companies, as an example, and then we'll talk about private companies, at least, again, how we have it set up is you can have certain individuals with view-only access versus ownership access on the account. You can have different approval quorums on the account. And so people on the leadership team pretty much have to go through a process of verification and would know if assets are moving out of the vault. Again, because you can audit only your Bitcoin holdings. Then at public companies, that same applies, but then it would be maybe a matter of communicating that out to the public after the assets have moved, that was a routine wallet management. But a little bit different, but ultimately the same infrastructure and foundation.
Okay, we'll get one more question. Tim, you got anyone over there? Tim, back there? Where's Tim? Tim disappeared? He's running? Good job on the color coordination. Your wives must have all talked last night of how to dress you guys.
So I have a question on insurance. I think that there's a lack of or dramatic deficiency in insurance among the custodians on a whole, and it's usually single incident insurance. So you have insurance for the overall custodian, and then it's diluted by the assets held by that custodian. Just wonder what your thoughts are and how that's going to evolve.
Mm-hmm. Yeah. Great. Oh, go ahead.
Yeah, I have a lot of thoughts on it, but if anyone wants to hear more, find me afterwards. The short of it is, I think that insurance is not the place to start with Bitcoin custody, because ultimately, if you are relying on the insurance and you end up having a claim, you're going to be working through a long process. And at least to my knowledge, most insurance policies are dollar denominated. So if there is future appreciation of the asset, you may not be getting paid out on that appreciation. So insurance, it's great depending on what it covers, but I think key management is absolutely critical and most important for mitigating failures and those risks in the first place. Again, I can speak to what we do at our company. We have an insurance policy that's narrow scope, focused on collusion risk, because naturally a question could be, well, what if two independent key holding institutions collude? Again, anyone who has that question, find me afterward, we can talk about it. But we have an insurance policy, and the way we have our solution architected is, since every client has their own wallet on chain, our insurance is per incident, and definitionally an incident can only happen at a given wallet at a given time. So this was underwritten by Lloyd's of London. And so it, again, is narrow scope, because we believe as a company that the key management should really mitigate out as many risks as possible. And then the insurance is really just the cherry on top versus the main thing to anchor to.
Perfect. That's exactly what I was going to say in a different way. So you're exactly right. Ultimately, the way to think about these things is first and foremost key management, right? That is your insurance policy per se. And you can really take a layered security approach with this, right? It becomes as important as when you buy your first Bitcoin as when you buy your 1,000th or 10,000th, right? And so key management, number one, there are plenty of materials out there by Unchained, by Theya, by Onramp to educate yourself on this. Build an in-house team if you'd like to. Distributing keys between your CEO, your CTO, your CFO, people who are at a high level in your organization who you trust. That's your first layer. That's your first insurance policy, right? You're eliminating single points of failure in that way. And then the same, to your point, Jackson, layering on top of that dollar-denominated insurance, right? So in the event that anything does happen, you have an additional fallback plan. And then I suppose on top of that, because you're doing this, communicating this to investors as well, that the Bitcoin that you're buying on their behalf is protected. This is your security protocol. And I think, our talk, as much as it boils down to security, it boils down to transparency, right? Telling your investors exactly what you're doing and how you're doing it, getting them more comfortable with your approach, in the same way that you're educating them and telling them and explaining to them through your directors of Bitcoin strategy, how you're buying Bitcoin on their behalf with access to capital markets, you should put as much attention into educating your investors as to how that Bitcoin is being custodied, and put that same effort into it in-house.
Yeah, I mean, I think, the future of insurance and the future of custody and the future of Bitcoin, kind of like we're talking about, it's still so early. Whether there's technical solutions like Miniscript that are going to make insurance products better and easier to use, or just legal solutions, or just as the price of Bitcoin goes up, there's more natural market demand to create better custody solutions and create better Bitcoin insurance projects. And so I think, just a symptom of it being so early in global Bitcoin adoption, it's still early in global Bitcoin insurance adoption.
Well said.
Fantastic. Thank you very much, guys. We're going to try to get a couple of minutes back here. So thank you very much.
All right. Thank you, everyone.
Bitcoin custody is evolving, and Onramp leads this change with multi-institution custody, eliminating single points of failure. Instead of one institution or complex private keys, Onramp secures your Bitcoin in a segregated, cold storage, multi-sig vault backed by 3 independent, institutional-grade custodians. No single custodian can move funds by themselves, providing an unprecedented level of security that traditional custody solutions simply can't match. Protected by a $100 million Lloyd's of London insurance policy, all transactions are fully auditable on-chain, never rehypothecated, and executed only at your explicit direction. This means complete transparency and control over your assets at all times. Beyond custody, Onramp delivers comprehensive Bitcoin financial services, including lending, trading, inheritance planning, IRAs, and more. Onramp functions as your private banking partner, coordinating key holder activity, removing technical burdens, and providing a personalized, trust-minimized experience tailored to your specific wealth preservation goals. Whether you're new to Bitcoin or an experienced holder, Onramp's approach helps secure generational wealth with unmatched security and peace of mind. Visit onrampbitcoin.com today to learn more, sign up, or book a free consultation with their team of Bitcoin custody experts. Hey guys, today's episode is brought to you by Stampseed. If you're in cold storage, you know how important it is to protect your seed phrase. That's why I recommend you head over to stampseed.com and check it out for yourself. This seed phrase storage device is one solid piece of titanium. There are no loose pieces, and you can hammer your seed phrase in letter by letter. When you go to stampseed.com, use promo code TIM15 for a 15% discount across the website. That's TIM15. Join us at the Win in Las Vegas, February 23rd through the 26th, 2026 for Bitcoin for Corporations. Use code KOTZ when you grab your tickets at strategy.com, and we'll see you there. This episode is brought to you by Arch Lending, the premier provider of crypto-backed loans designed for both individual and institutional investors. At Arch, your digital assets work for you without selling them. Arch offers flexible loan options tailored to your needs. Backed by industry leaders like Morgan Creek Digital, Castle Island Ventures, and Galaxy Ventures, Arch Lending is setting a new standard in crypto-backed lending. Are you ready to unlock the potential of your crypto assets? Visit archlending.com to learn more and configure your loan today. Are you looking for comprehensive analytics on corporate Bitcoin adoption? Strategy Tracker delivers real-time insights into how companies are executing their Bitcoin strategies completely free. Monitor NAV premiums, cost basis performance, and track how corporate Bitcoin treasuries perform against the market. Upgrade to Premium for just $3.99 a month and unlock exclusive benefits like detailed market rankings, real-time trading volume analysis, and advanced performance metrics for corporations embracing Bitcoin. Apply code KOTZ at checkout for 100% off your first month of Premium. Strategy Tracker is your essential tool for measuring the effectiveness of corporate Bitcoin strategies. Visit strategytracker.com and gain the analytical edge in understanding the Bitcoin Treasury phenomenon.